Most people that consider doing a 1031 exchange are interested in deferring all the tax. They would be disappointed if, at the end of the transaction, they discovered that they actually have some tax due. Before I explain how this works, I want to emphasize that tax rules are very nonsensical. They're illogical. So you should never use the word logic in the same sentence with tax rules. That's very important to realize and understand. So when you're doing a 1031 exchange, and let's say you're selling a property for $400,000, and let's say it has a $200,000 loan. Maybe you paid $300,000 for it 4 years ago, so you're deferring $100,000 of gain because it's gone up in value from $300,000 to $400,000. So to get total gain deferral, you have to do two things. You have to use all the proceeds, all the cash. So in this instance, there's a $200,000 mortgage, and you're selling a property for $400,000, so there's $200,000 worth of cash proceeds. You have to use all of that, and you also have to replace or offset the loan that was paid off, that $200,000 loan. That's what trips up most people. They think if they spend all the cash, that they'll defer all the gain, that there's no tax due, and that's just not true. As a matter of fact, if they spent all the cash and bought nothing else, that would be a $200,000 acquisition, they would defer no gain and they would have to pay tax on that $100,000. So the best rule of thumb, as opposed to going through the more technical explanation I just gave, is if you buy replacement property that's the same price or greater than what you sold, and you use all of the cash, then you'll have total gain deferral. So again, two-prong rule. Same price or greater, use all the cash. If you do that, you'll defer all the gain. Thanks, and as always, we try to help you maximize the benefit of your exchange transactions.